Hi, welcome to session 9. What we are covering in this session is a critical aspect for any entrepreneurial finance project. Where can we get the money that we need for our project or new venture? This is what we are discussing in this blog that is called Sources of Financing or Sources of Funding. What we try to understand in this session is that not all sources of potential resources, in this case we are talking about monetary resources, funding, are the same. Not all different stakeholders, different potential investors behave the same way, expect the same things. Therefore, we should not approach them at the same moment or even not even in the same way. There are many different classifications of the potential different types of investors that we can see. We will focus on the main ones. What we need to understand is that we will be trying to position at every stage of the evolution of the new venture what type of investor could be more suitable and what will be their expectations. That's what we describe with stages of financing, then going a bit more detail in the sources of seed stage financing, thinking about the concept that we group inside what we call expansion financing. So this means when you're trying to grow, when you're trying to enter new markets, maybe develop new products, new services. And then also we, very briefly, just that you have the information, we discussed this concept of the initial public offering. This means going public, going to the stock market. That's what a lot of times you see with the acronym IPO. It's also important that you use the times that you have in these sessions to revise previous assignments, think about questions you might have and clear points, and also that you block time that it's necessary for the last assignment work on the valuation project, as this requires quite a bit of your time to put things in practice and test your knowledge. First of all, when we say that we need financing, it's a very specific type of financing. We need early stage financing. And when we talk about early stage financing, it's very different from when we go, for example, to the bank to ask for a mortgage. This is a situation where we are still building up an idea, when we have limited track of our performance in the market. We maybe don't even have clients. And we are asking to other people to assess our feasibility, our business potential, and invest in us. And in this case, kind of give us money in exchange of a participation in the business. We say that early stage financing has much more uncertainty and much more challenges and complexity than when we are looking at a mature project like opening a franchise or even kind of getting a loan to buy a house, that are usually much more structured and clear processes. We also separate the other type of financing when we call expansion stage financing. And we do that because when we are looking at the expansion stage, the story and how we approach investors is much more about growth, is much more about replicability of what we've done, is much more about how well we can scale our business and how we can maybe beat even potential competitors that will be coming up as we grow and develop. That's why the two blocks are separated between early stage and expansion stage. So what do we have in early stage? Basically, in early stage is this whole concepts that you might already have heard about, of this seed round, pre-commercialization financing stage. And this is those moments where we need, when we say first round, the first money that comes into the company from outside, not from the investors, not from the founders. So it's the first time that we get somebody else to put money into the company. What does this mean? That we need to cover some types of costs that are related to administration, development of prototypes, some market testing, and also hiring some technical staff, especially if we are thinking about our technology-based projects. This is a moment where there is a great risk, things can go wrong, there is no product in the market, there are no clients, but also, as you can imagine, to invest in this very early stage might also give very big payoff, or what we also describe here as a great rewards. Because what happens in this situation is that what you can ask in exchange, that participation, is being given at the moment when the valuation of the company is also full of uncertainty, therefore is much more hardly discounted than later on as things become more certain and more predictable. So is it a bad thing to invest in early stage? Not necessarily. So as we continue, it's also important that then we look into how does this develop as a process. What happens here is that usually at the very beginning of this situation is where we have the founders or co-founders that are the people that actually put the business in motion. But then there are all these other actors that could be jumping in likely, and that they are the ones that actually will make the business evolve and potentially develop and go through all those different stages, from what we could describe as the valley of death to maybe the situation where there is a break-even, early stage, late stage, even when you go eventually even public. This possibility of seeing the evolution has to be compared or has to be related to the different types of funding that is happening. This is what you see in the upper part of the figure, that you can see how the different actors that are potentially part of the, let's say, investment landscape, they are the ones, maybe they are the accelerators, the angels, the friends, families, and fools, the seed capital, or the venture capitalists, and also maybe the larger funds that could be involved. This, as you can imagine, is just a description of a potential cycle. It doesn't necessarily happen for most startups that it goes like this. Another way of looking at that in a more kind of nuanced approach is also to try to understand that there is many different possible actors for each of, this is what you see here on the bottom part of the graph. And then you also see that there are different possibilities when it comes to the early phase, expansion phase, stock market, or the public to private markets. When this is basically the different steps that might be going on in the development of the venture. What they try to tell us is that there is an instrument, there is a funding possibility for each different stage. It doesn't mean that it has to be used, or it has to be necessarily the moment that you actually go into maybe getting a business angel or a venture capital, but it means that when you are at this stage, this possibility makes more sense than in other moments. So it's very unusual that maybe you can go public as you are still an early stage company, or it's very unusual that the seed fund or venture capitalist will want to invest in your company when you are already very mature. At that time, maybe it will be a private equity, or as they say here in this graph, that maybe the company is already public and you take it private again. And that's in that moment, for example, this is a story of the computer maker Dell, that at some point also decided to go private again, and now they are public again. So some of those processes are not very common, especially the last ones, this public to private, or even to go public in the stock market. Only very few of the companies do that. And if just to give you an indication, from all the different new ventures that kind of are started every year, less than 10% get venture capitalist or venture capital funding. Most of the new ventures are actually funded by the founders that put the money in. They get maybe some friends, some financing. There is a lot of bootstrapping. There is a lot of these more informal processes. Only few of them follow this pathway. But this is the most attractive, high growth, high impact pathway, and that's why we pay attention. We keep moving on. What is interesting for us is to also understand some of the differences, for example, between the bootstrapping financing, that is this option that when you get started, you are still maybe employed at another company and you are using your salary, some of your savings, personal assets, some friends to get the business going, to get this new idea tested and to move ahead. As you can imagine, the bootstrapping can also have some negative effects. It's maybe a good moment now to also that you pause and that you think about, okay, what could be the downside? As you can imagine, now we continue, one of the downsides is that basically by bootstrapping, you are maybe not making the optimal decisions for the growth of the business. So you are maybe going slower than your potential competitors or new players that are doing something similar. This means that at some point you might need to turn to what we describe as seed financing. This seed financing, maybe a small loan, angel investors, some angel groups, even sometimes accelerators, incubators, and even we could sometimes put also some crowdfunding, equity crowdfunding or platforms that are able to provide this seed funding. What this helps is that you are able then for some time to make that decision to maybe stop working, stop other projects, and fully focus on your new company, your new startup. We call it seed because of the concept that it's still not visible, the flower or the plant that might come out. It's still a moment where you need some help, some support to get things in motion, maybe to get that first client. It's an interesting term, and it's a good description of why is this money useful. More things that are important. So it's not unusual that you have heard maybe about the seed funding or even about venture capitalists, but at some point somebody tells you we need to do a due diligence. This is a concept that I would like that you remember. A due diligence doesn't mean nothing special, but actually is kind of a checklist of things that an early stage investor will want to see. So it's a very good idea that you always have some of those materials, like for example, background of the founders, what is your business model, to document some of your maybe meetings or the business plans you have had, to have information about the management team, and also which are your target markets and how are you working. So all those documents that you might be using internally for your own planning, part of them can be the documents that you also want to share with that potential early stage investor. So what it means is that they would like to, from an external viewpoint, look at those documents and see whether everything makes sense or not. And that's what we describe as due diligence. Due diligence becomes more complex as we are maybe talking about acquisitions of large companies when they want to spend maybe 2 or 3 weeks or even more time looking at all the accounts, that actually things are properly done or properly accounted for, audited, and so on. But for the early stage investors, it's more about doing some checks that what the entrepreneur is telling about the market or the potential makes sense. The objective here is to avoid cases like Theranos. And the whole story here is that as an early stage investor, you should do your homework, not just rely that somebody else will have done the due diligence. So what happens then, for example, if you are not able to maybe get that seed financing that you would like? A lot of people, especially in some markets like in the US, they use like revolving cards or even credit card financing. This is kind of a risky approach, but people actually end up using it. Some people even mortgage their own houses or remortgage them to be able to then have some money available. It's usually better to use something like maybe vendor financing or even client financing. So maybe some of the clients can advance the money for a first order even when it's not yet finished. This more industrial type of financing. These type of approaches are, let's say, less financially expensive usually than using a credit card or your kind of bank facility that is not thought for that. The other profile that is very interesting at this still early stage is these angel investors. Angel investors are interesting because they actually do not only provide some of the funding you might need, but also provide a network. And that's what you also want at this time. Maybe, for example, an angel investor that knows well the food industry in your country, then he's able to actually help you to get that first client or maybe get that supplier that will be helping you to develop the business. So what we have been able to see is that thanks to angel investors, startups actually are more likely to survive and also get additional funding. Angel investors is kind of the first signal that you are doing something good. So when an angel investor joins in, it's a good first signaling strategy that maybe this will allow you in the future to also get some more venture capital or other types of funding. So it's good to have them on board. The only things that we need to be aware is that sometimes they don't behave or they are not as structured maybe as joining a seed accelerator, where they maybe will put some money in exchange for a small stake, but then you will get a structured, what we call also kind of a structured accountability process. You will get mentoring, you will get some milestones, and this will actually push your idea forward in a more established way. No? Very different the concept of incubators, when basically what they offer is the idea that you have a space, that you can develop your idea at your own pace, And maybe there are also some additional services like some mentoring or some support, but it's more hands-free approach when actually the accelerators are much more oriented of pushing you through a specific process that they think works. What does this also mean again in practical terms? It means that the choice between joining an accelerator or looking for an incubator is an important one, and it needs to make sense to the team, the entrepreneur, and what are you looking for at this moment for your company and your project. Now it's again a good moment to stop and look, combining the words of accelerator or incubator plus some of the words that define your region, and you will be able to find local players. You can pause now if you want. We continue. What we want now to also get a quick understanding is what is a venture capitalist, because this is in the moment that we are already moving into expansion financing, and here we are looking at people that actually they work in a quite different way from the accelerators that work with cohorts or with programs. Here you see a venture capitalist. Basically, this is a professional that is managing a fund that has been money that has been provided by family offices or other people that have money available. They decided to invest in a fund that is created by this venture capitalist firm. And then the venture capitalist firm, what they do is just imagine that there is a fund of 100 million euros or 1,000 or 800 million krona or whatever, an amount like this. This is the usual size of a VC fund. And what they will be doing once they have this $100 million, they will be looking at opportunities in the following years during the duration of that fund, that they will be looking to invest in some startups. Their objective is that by the end of the life of the fund, they can return. So they can exit those startups, sell them, maybe have another fund that takes over their position, or maybe liquidate, or with the objective to return more money to the investors that put money in the fund than what they ask at the beginning or what they put at the beginning. People usually say that VC funds should be performing much above the usual stock market. Reality says that actually few of the VC funds are incredibly high performers. A lot of them, the large majority, underperform even an index like the Standard & Poor's 500. If you're interested in that, just drop me a comment and I will share with you some of the research that explains this. So it's a very skewed performance that the venture capitalists have. And as you can imagine, the professionals that manage those funds, they charge a commission. And that's the only thing that is secure, let's say, in the performance of the fund. So just to be clear, that to break some myths, VC funding is not the only or primary source of funding for startups. There are many other sources. Also, when VC funds take positions in startups, they come in with something we will talk later, that is this letter of intention or a very clear term sheet. They protect their interests. So yes, they are taking risk, but they are also taking control risks. Also, the idea that the VC funds or VCs are actually great because they will give you all the mentoring you need. Yes, they are good, but not necessarily it's the only source that you can get for some of the mentoring. And basically also the whole concept, I'm going to the last point, that VCs are innovators. Actually, VCs, venture capitalists, are looking to maximize their returns. So they don't necessarily fund those innovations or more radical products. They will fund those products that they think they can exit at the maximum value. So if it's an app that offers what we or some of us would describe as a stupid service, if they think that this app can be interesting to sell to maybe Google in 4 or 5 years or to Facebook, they will invest in this even if there is no social value or no big innovation. It's not a criticism, it's just a description of what that is not necessarily true that they are very eager to invest in breakthrough innovations. So just that you are aware of that. There will be some videos or some articles to expand these concepts that require much more attention. So what is usually something important to keep in mind when you're looking at all these sources of financing is that very soon things get into legal terms. And then it's important that you get a lawyer, somebody that is a legal expert and helps you to understand those things. For example, things that you already can give a quick look and see how intimidating they can be for someone that is not kind of vested in these legal aspects is to look for a letter of intention from a venture capitalist or an investor. And also you can look at something like a startup term sheet, and you will see also all the different aspects that appear. Some of them very legal, very specific on the financial language that make it difficult sometimes for startups to understand the consequences of what they are signing. Moving to the last points, so what else happens? So there is also other options. Sometimes there are corporations, large established firms, that also have their own VC part. What has happened is that as large companies were looking for opportunities to stay innovative, some of them realized that it's hard to make this happen inside their own company, so they decided to create a fund inside the company, using the resources from the company to invest in external startups, things that are happening out there. So for example, just to get an idea on how big they are in practical terms, they are about 10% of the total funds being managed by VCs in the world. And there are nice cases like there used to be a case, for example, in Denmark with Danfoss, the Danfoss Ventures. Eli Lilly has had very successful cases with Lilly Ventures. And sometimes there are other types of funds that behave like this. Maybe sometimes it's a few companies that put some resources together. This is just, if you look also for the term CVC, you will find out also more examples of this type of special funds. The last step that only happens for some companies, you can see how many companies are public in your country, and you will see that it's not the most usual thing. But this, that you go public, that you issue shares, the shares that you, maybe new shares, or that some of the shares that your original shareholders have, you make them public, you list them. When we say that we list, is that we make them available to the stock market, and then people can buy that stock. And then, as you can imagine, this requires a previous process of valuation, of establishing a value for your company, and then the market from that moment onwards will also have, as long as the shares stay available in the market, will also have a price for your shares. So this is in a very synthesized way the big or key content for this session. Now it's time to focus and allocate as many efforts as possible into working in the last assignment. Just some comments that is important to understand what is the company you're analyzing, in what in the industry they are working. Try to find similar existing companies. Try to also understand what type of company and what stage are they right now, and also what information do you need to build the model, to build your valuation, and all the different options that you might have. This is it for this session 9.